And welcome to the Minnesota Real Estate Show. Thanks for tuning in. Sunday morning here, 10 a.m. and April the 23rd. We're live here at Love 105 FM every Sunday morning for the Minnesota Real Estate Show. This is a real estate show hosted by Mike Overson of Luminate Home Loans, Scott Wolmering, myself, Ryan O'Neill of the Minnesota Real Estate Team, RE/MAX Advantage Plus. It is a fun show. It's interactive. We welcome your questions, comments, thoughts anytime up until 11 o'clock. You can either comment on the social media stream, wherever you might be catching us, Facebook, LinkedIn, Instagram, Twitter, YouTube, you name it, wherever you are. Thank you for joining us. And again, we're here until 11 o'clock talking everything about the real estate market, about the mortgage market. Today we have Adam Hartung in studio with us with Midwest Money Management. Really kind of looking big picture at kind of economics, money, things overall. But again, 612-294-6949 is how you can join us. Scott, good morning to you there. Nice to see you there, bud.
Yeah, good to be here. Thanks everybody for tuning in. Like Ryan said, we're going to go live here in about 30, 40 seconds, 105.1. Love your comments during the show. Just type them in. We'll handle them as they come in. Like Ryan said, we're going to talk everything real estate and mortgage related. We're going to talk a little bit about the new Biden thing that came out where he's giving people breaks and penalizing others for mortgages. We'll talk about what that means. And then just everything about what's going on in the Twin Cities.
Yeah, again, 612-294-6949 is how you can join us at any point. It's the spring market. We are going to be updating in this first segment just from a number standpoint. And here we are. We're going live on Love 105 FM. Well, good morning and welcome to the Minnesota Real Estate Show. Thanks for joining us, everybody. April the 23rd, 2023, and we are live here every Sunday morning for the Minnesota Real Estate Show, hosted by Mike Overson, Luminate Home Loans, Scott Wolmering, and myself, Ryan O'Neill of the Minnesota Real Estate Team, RE/MAX Advantage Plus. Thanks for tuning in. Thanks for joining us. This is a live and local real estate show, again, every Sunday morning, 10 a.m. to 11 a.m. It's interactive. We welcome your comments. If you're catching us on any social media stream, LinkedIn, Facebook, Twitter, Instagram, YouTube, or again, listening to us on Love 105 FM, thank you. Throughout the show, if you have questions, comments, thoughts, please don't hesitate to share those. A lot to talk about today with the real estate market. 612-294-6949 is how you can join us by phone or by text, 612-294-6949. Good morning to you, Scott. Nice to see you there, buddy.
Yeah, good to be here. Welcome, everybody. Appreciate you tuning in. If this is the first time you've caught us, like Ryan said, we are live and local, and we're here for an hour every Sunday till 10 o'clock to 11 o'clock. So if you would like to join us, 612-294-6949, you can go live on air, or you can text us your question, and we will handle those as they come in. Been doing the show for, I'm just thinking about this, I think this is our 18th year that we've been doing the show, and every market has its struggles. This one we'll go over kind of what that is, but every market has it.
You're right. You're right.
Every single one.
Well, especially for, again, any maybe newer buyers or sellers to the market, or newer agents to the market. Every year there's some kind of challenge, and of course it's what you hear in the news and what people kind of tell you maybe at the at the gathering, the family gathering. You kind of hear different little tidbits of the market. And with this show, again, what we want to do, we kind of live and breathe the real estate business 7 days a week, and so we're here to kind of share information, the good, the bad, and everything in between, Scott.
It is, it was funny. We always kind of joke between us back in 2007, 2008, that, you go to a cocktail party and people be like, "Oh, what do you do?" And you say, "Oh, I'm in real estate." And they're like, "Oh my gosh, you okay? Are you going to be all right?"
It was like a death in the family.
It was. They would look at you like, "Oh my God, are you eating ramen noodles? I mean, how are you making it?" And this market's no different. It's a reversal. Back then, you would carry oh gosh, I think we had 100 and something listings at one point. And you get, one showing every 60 days.
Yeah.
And now there are no listings. And so you put one on and you get 100 showings and
Right.
15 offers. And, which sounds great. People say, well, that's great. Why is that a problem? Well, the problem is units are down, I think, about 40%.
Yeah.
And so, yeah, they sell quickly. There's not as many of them as being sold.
Adam Hartung, Midwest Money Management. Adam, are you thinking of becoming a realtor?
I have not considered that, no.
You'd be a good realtor.
Adam would be.
I remember when I first started working with you as a client, I was like, oh, I'd love to get him to become an agent.
Appreciate that.
Hey, the first segment, we do like to dive in, an update from a real estate and mortgage standpoint. Our friend, Mr. Mike Overson, will be joining us very soon, live in studio. So we're going to do the real estate update here first. And again, at 612-294-6949, how you can join us. The stats, very similar to what we've had the last number of weeks, but new homes for sale in the Twin Cities down 36%. So 36% less new properties for sale. This is comparing year over year, again, with last year, 2022. Pending sales, Scott, down 32%. Very significant drop all across the Twin Cities. January, February, March, now into April. Those are some really similar numbers with pending sales, accepted purchase agreements way down 32%. The inventory, though, is up 5%, 4.8% increase. There's 5,766 homes for sale. But before the show, Scott, you made a good point. People say, well, why is the inventory up 4.8%? We started way lower.
Yeah.
We just started at a lower amount. But it's still just crazy low.
Yeah, I mean, 5,700 homes in the market. For those that haven't caught the show, I say it all the time. 18,000, 19,000 homes in the Twin Cities is a balanced market. That is equal amount of buyers, equal amount of sellers. That's the good old days where you get in the car, you go out and you take a look at 123 Walnut Street, you like it, you go home, you talk about it with your wife, you go back out the next day, you do a second showing.
Then you talk some more.
You talk a little bit more. You think we're going to write on that one.
When we negotiate.
Yes, and we'll negotiate with the seller. We'll give them less than list price.
Lots of closing costs. Paid.
Yes, all that fun stuff. So that's what happens when you have a balanced market. In this market, it is a new one got on the market. You run out with your agent. You see it. You go back to your office. You write the offer. You find out there's 10 other offers. And they're going to have to wait 2 days until they look at highest and best. So that's this market.
So you get a text message. You're in the middle of church, and you leave church.
You leave church.
That's terrible.
Yes, you do.
Adam, you would not do that.
No.
It is interesting though. I was actually on a date the other night with a woman that had been married to a real estate agent.
Okay.
And she's like, oh my gosh. She's like, do you leave dinner like if something comes up? And I said, well, I don't now, but when I first got in the business, I was 27, and yes, I would literally if a client called, I would leave dinner and go with the client.
Yeah. So again, an interesting time, interesting market here. 612-294-6949 is how you can join us at any point. If you go to mnrealestateshow.com, we've got a nice tool. If you're an existing homeowner and you just want to see what the value of your home is, again, if you go to mnrealestateshow.com, it's a nice option just to get an idea. Hey, what's my home value? Where are things at currently with this market with rising prices? Scott.
And we actually do that. I mean, there are tools out there that you can plug your information and it'll kick you out a number. This is actually a licensed agent on the team that looks at your home, does an online market analysis. So it's a legitimate number. I always say it's within about 3%. Obviously, without physically looking at the home, it can't be exact because you haven't seen the finish level, but it's a pretty close number.
I have a quick thought for you. We had a comment this week. I attended an event, and it was interesting. It was a panel of these top producing agents around the Twin Cities, and one of the people on the panel commented and said, when in the Twin Cities or why in the Twin Cities did we start this phenomena of putting all of our listings on a Friday? So then on the weekend, when you are at your kid's sporting event or you're at church or you're at wherever, that you got a 911 leave, you're running, everybody's scrambling on the weekend. And her point, she's a really good agent, top agent. She's like, I put all my listings on a Monday. And she said, from a seller's perspective, agents are more agents are working Monday through Friday. So it was interesting. It was kind of an argument. She was trying to say, look, why have we created this weekend thing? And any thoughts on that, Scott?
Yeah, I mean, I do, and I agree with her. I typically put mine on Wednesday or Friday, and then I normally put them on coming soon a couple days before that, just so I can kind of see some of the numbers that come in. One of the reasons that in this market I like to put them on a Friday, especially if you're going to have an open house,
Sure.
because you can actually have the open house. If you put them on Monday,
Yeah.
there's no way in the world you're getting to an open house on the weekend.
Sure.
And so, depending on my seller and whether they prefer having open houses, in order to actually even have one, I'm not a big open house guy. You know that through the years. And as the internet has really taken over, the reason that I don't like opens now is because you have so many people that will pull it on Zillow and everything else, and then they'll come through the open. So you, in some cases, could lose 5 or 6 or 7 showings because those people come through an open and don't set up a showing. So when you're looking at trying to get your numbers squared away, how many people are looking at it, and et cetera, an open house can kind of throw that off.
Yeah, again, 612-294-6949 is how you can join us here at the Minnesota Real Estate Show. We've got a lot to talk about. There was some news this week from the Biden administration, some new rules regarding mortgages that essentially, looking at various online reports, that will force good credit home buyers to subsidize the costs of buyers with poor credit. And it's interesting. There's been a lot of commentary about it. I saw an article, Scott, that was a former Obama housing official that came out, called this an unprecedented move, and was arguing that this is not the way to bring in more home buyers. Went on to say we can do better programs to help more minorities get into home ownership. This is not the way to do it. But essentially, the new rules from FHA, Scott, will allow consumers with lower credit ratings and less money for a down payment to qualify for better mortgage rates than they otherwise would have. And in turn, those costs are passed on to those with good credit. And those rules are set to go in effect May 1st.
Yeah, I mean, and I agree with the Obama administration's take on the fact that there are better ways to do this. I get the concept. The concept is to be able to help people that are already kind of financially strapped, to help them to be able to get into a mortgage and make it affordable. I get that, and if there's money available for that, and we want to put some funds at that, I guess I would wait to see what that looked like. It's the penalizing those people that have good credit to basically make up for the money that's being spent on the other side. That I just don't understand.
Yeah, we're up against the
I don't
first
get it.
break here at the Minnesota Real Estate Show. Appreciate you joining us. If you're catching us on social media, thank you so much. This is a live show. It's local. It's fun. We welcome your questions, comments, thoughts, the good, the bad, and everything in between. We're talking today about that new rule from the Biden administration to help those with poor credit scores. If you have a feeling about that, call us. 612-294-6949 is how you can join us at any point. This is the Minnesota Real Estate Show. Well, we've got our friend, Mr. Mike, is going to be coming in very soon as well. A lot of you joining us here today. Thank you so much for that, Scott. There's going to be a lot of opinions about this. If you're watching, you have commentary, please don't hesitate to share it. What's the thought behind it? Why are they doing it?
Well, it's like any other program. It's the thought is to let people believe that the government's helping them to be able to afford a mortgage. And like I said, if it was a good program and we had money to do it, which we don't, But if we did, and you were going to put some money at it, that part, I guess you could argue whether that's good, bad, or indifferent. The penalizing the people that have good credit scores to basically pay for the people that do not. That's where it loses me.
Yeah.
I don't get that.
Yeah. Again, and we've got Adam Hartung here, Midwest Money Management, and Mr. Mike Overson. Mike, we're just talking about the new rule from the Biden administration, and help us understand, Mike, for everybody watching online here too. Why was this done, and what are you hearing kind of in the market?
There is no understanding it. It doesn't make any sense. So
Yeah.
no one will understand it because it's completely stupid in my opinion. So
Mike broke his mic.
so I don't know. So I can't help you understand it because I don't even understand why you would do something like this. So that's my reason. Now I can tell you basically what it is. It's almost like income taxes, right? Right? They're gonna collect more from those that pay to help cover those that don't. And so it seems like they are now going to charge the good credit borrowers more to help subsidize lower credit borrowers to get a lower rate on their end. So they're trying to squeeze everything together is what they're trying to do, kind of like what FHA does with their mortgage insurance. Everyone pays the same rate, right? So if you got a 750 credit score, your mortgage insurance with FHA is here. If you got a 650 credit score, you pay the same rate of mortgage insurance, right? So they're gonna basically the higher credit borrowers are paying for the lower credit borrowers, and they're trying to squeeze everything to the middle.
So does that affect everybody with like what type of loans are affected?
This is on conventional loans. So conventional loans only across the board is where this goes into effect.
Which is the most common type of loan, right?
Which in today's world, I mean, 75 to 80% of loans out there being done are conventional loans. Absolutely.
Mike, has this gone into effect yet?
They try to put it into effect on April 1st. And so lenders have actually been building it into their pricing since probably the end of February. Because what happens is it's not on the loans that you lock today, it's the loans that get delivered to Fannie and Freddie. So if you do a purchase agreement on February 15th and your closing is on April 5th, right? We have to build in this hit to your interest rate because we're going to deliver that loan to Fannie and Freddie after the April 1st start date. Now, there's a lot of pushback in the industry. So they pushed April 1st date back to, I believe, August 1st now. So it'll go into effect August 1st.
Isn't it May? They're saying May online. Everything is saying May.
Yeah, it was August. I mean, I got to get a little up to speed on that. If they moved it back forward now to May, that could have happened.
Looks like it's May.
They tried to start in
August
August.
everywhere.
Yeah. So anyway, so that's the scoop. So every lender is building it in. They've already built it in because they know it's coming. So, and if you close beforehand, it's like, okay, well, you're still going to pay for it because we have to build it in because we got to meet the delivery date.
We're going back live on Love 105. Thanks for tuning in, everybody. Hope your weekend's going well. Hey, welcome back, everybody, to the Minnesota Real Estate Show, live here at Love 105 FM every Sunday morning, 10 a.m. to 11 a.m. We're a local real estate show. We welcome your questions, comments, thoughts, 612-294-6949. We're just talking to Mike Overson here about the Biden, the housing administration, the new rules about having those with lower credit scores are paying, basically those with better credit scores are paying more, and those with lower credit scores are paying less. And I asked during the break, what's the rationale for this? And you said you don't have any rationale.
No, you said stupid. There is no rationale.
It's like,
That's what you said, exactly.
So everyone asked me, like, try to help me understand why they would do this. And I'm like, I'm sorry, I can't, because I don't understand why they would do this either. It makes zero sense. So I can't explain it.
Well, and I think of all people to have on to really talk about this today is Adam Hartung. I can only imagine, Adam, I see the heat coming from your head,
Can we put,
seething the anger.
can we put a blood pressure cuff on you?
That would actually be fun.
This is unbelievable. I mean, I came here. The irony is, I feel like I am always so negative every time I'm on the program, and so I came today with content and the idea of being optimistic and positive today.
Thank you.
And then you got hit with this.
I have not heard about this new rule, and I can't. Again, I'm just so frustrated. I mean, you ask, why would you do this? I mean, again, this is going to sound outlandish, but this is straight out of the Communist Manifesto. It is take from those based on ability and give to those based on need. And that sounds like a great idea, but the problem is in the real world that doesn't work. I mean, this is the worst idea I've ever heard of.
Yeah, a lot to talk about. If you have an opinion or thought, don't hesitate to call or text us 612-294-6949, or comment on our social media stream. Again, Mike, just an update before we dive in with Adam Hartung. Where are interest rates right now? What are we seeing, and what's the prediction again as we move further in the spring summer market?
Yep. So one thing to remember is, kind of what we've been talking about with this news that is finally coming out, right? So we knew about this back in late February, March, and lenders have been pricing this, these adjustments in already. So don't think that when May 1st comes around or something like that, it's going to be this big change. The change already happened. The news is finally just getting their hands on this information and finally getting it out there. So, but as far as interest rates go, they went down a little bit this week, like down 1/8%, maybe a quarter, a little bit, but that was also on the tails of last week, them going up about, 0.5%. So, so we're going to see those ups and downs. Last week I spoke about, it's like our April weather, right? We're going to have good days. We're going to have bad days. There's going to be a roller coaster. But in general, if you look from the start of April to the end of April, our temperatures will be getting warmer, just like our interest rates from start to finish. Our rates should be just trickling down.
Had a comment here. My friend, Mr. Joe Mack, awesome agent. Joe said, Mike, I was under the impression that it's quite a matrix break out of the adjustments on rates regarding the new administration rules.
Yeah. So they don't. So whenever these loan level pricing adjustments is what they're called, right? So it's based on.
Do I need a blanket for you here
right?
too?
So based on your borrowing profile, your credit score, your debt to income ratio, your down payment, like all these factors that go in there, they have adjustments to your rate. So basically, if you have a 780 credit score and you got 50% down and stuff like that, you don't have any sort of adjustments, right? The adjustments come when you have less than 50% down and you have credit scores under 780. Then they basically rate those buckets based on risk and they adjust your cost. So for example, let's say you have a 720 score and you have 10% down. Your 720 score, it's going to cost you 50 basis points. So 0.5% of your loan amount. So on a $400,000 loan amount, that's $2,000. So it's going to cost you $2,000 for your credit score. And for the 10% down, let's say it's going to cost you another 50 basis points. So another $2,000. So you got $4,000 worth of adjustments to your costs. And so you can pay for those adjustments in one of two ways. You can actually pay the $4,000 and not increase your interest rate. Or what most people do is they don't have the $4,000, so they're going to increase their rate. So now your rate's going to be 3/8 higher, right? And then you're paying for those costs through the rate and not an actual fee.
What's going to be interesting with this, because when I hear that, people with good credit scores are going to be paying for those that don't, and we've really gotten to a point where everything is just out in the open on loans. This will be one of those where people will not be able to see it. I predict, because if you went to buy a car, and we're both looking at the same Porsche for $40,000, and then I say, yeah, I'll take it for $40,000, and then my salesperson said, ooh, you know what, Scott, you have an 800 credit score, so you actually need to pay $41,000 for it. And then, but Jim over at that table, he has a 550 credit score, he gets to buy it for 38. No one would do that,
Right.
People would lose their mind. This is just going to get slipped in there. You're going to go, and you're not going to really know that it's happening.
Yeah, well, I'm still going to lose my mind.
Yeah.
Hey, let's do your formal disclosure.
Yeah, let's do that.
Yeah, please. Mr. Adam Hartung is a certified financial planner professional and an accredited investment fiduciary. He's the president and founder of Midwest Money Management, located at 17316 Kenyon Avenue in Lakeville, Minnesota. Securities offered through Parkland Securities LLC, member FINRA and SIPC. Fee-based investment advisory services offered through Sigma Planning Corporation, a registered investment advisor. Midwest Money Management is independent of Parkland Securities LLC and SPC. now that you're legal, Adam, what do you think?
You know, I'm just thinking through the logical consequence of all this. You know, you just said that your credit score is too high, so it's going to cost you an extra $4,000. Think about for years, like the credit repair agencies, that people would come in and their credit score was too low, and so you'd say, well, you know, Mike could tell them, well, go work with the credit repair agency, we'll get your credit score up so that you can qualify for a loan. Now we're literally going to have people say, well, you know, if you missed a couple credit card payments, and temporarily knock down your credit score, we could save you $4,000 on your mortgage. I mean, what a stupid idea is that?
So when you hear this, right? So keep in mind that a higher credit score is still going to get you a lower interest rate, right? It's
Okay.
just that let's
To
think
help us
about it.
understand that.
So think of it. So they have a base rate. Let's say there's a base rate of 5%. Okay, that's your rate, right? So that's the base rate. Everyone starts at 5%. Now, based on your credit score, what adjustment do we make? So for an 800 credit score, there was no adjustment to your rate. You would stay at 5, like the old rule, right? So the old rule, 800 credit score, you'd stay at 5. If you had a 720 credit score, now we got to hit you a quarter for your credit score. So now the 720 went to 5 1/4. The 800 credit score is still at 5. You know, then you take your down payment. Well, the down payment for the 800 borrower was 5% down. So for 5%, now we got to adjust your rate 0.5%. So now you're at 5.5, and there's 5% down for the 720 score. That's another 0.5%. So now that person's at 575, right? And so you go through all these buckets and you just make these adjustments. And where do you end up at the end of the day? That's your rate. The adjustments now are bigger with higher credit score borrowers and lower for the lower credit score borrowers. So now instead of a quarter adjustment for the 800 credit score borrower with 5% down, now that's a 0.5% adjustment.
That's where they get whacked.
And now the 720 score used to have a 0.5%, but now they're only going to go down a quarter to a 1/4%. So in general, still the higher credit score borrowers will still get a lower rate than lower credit score borrowers. It's just those adjustments are going to start squeezing them together, where now an 800 credit score and a 700 credit score are going to have more similar interest rates than what they have now.
You're being squeezed, Adam.
Well, and the buyer will not be told, oh, you know what? If this was 4 months ago, you would have been at a 1/4 point, but now you're going to be at a 1/2 because you're paying for this other person's loan.
Right. Yes.
They will not be told that.
Sure.
So they'll just know, oh, I got to pay a 1/2 basis point.
Well, again, I mean, regardless, this is not a political discussion. Of course, we don't dive into it, but I do think it is interesting. I mean, that this Obama advisor was commenting on that, just saying that they don't think that's a good move. So it's just, I don't know. I think the real estate market has enough challenges right now, guys, that this is maybe something else to throw in the mix that causes everybody to say, wow, what am I doing here?
And this is also like, you know, the subprime mortgage crisis that we had before, that also was created by government policy, by the way. And that was, you know, the zero down, the no income verification. I mean, all the things that we did before. And this is different, but it's the same idea in that you're subsidizing poor behavior and poor decision making instead of rewarding smart decision making. Where does that ultimately lead? Well, it ultimately leads to a crisis. I mean, that is what this is another crisis in the making. I mean, it's not going to happen tomorrow. It's not going to happen 6 months from now, but that is what this policy leads
That's
to.
optimistic.
Yeah, exactly.
I agree. It's predictable.
It's predictable.
Just keep your hands out of the free market, for crying out loud.
Mike, you had a thought there
So-
before the break?
So I'm looking at the chart here, and I sent it out. So I mean, everyone who looks at this, you know, it's color coded, so Scott can even follow it. But basically, the red is bad, the green is good. Basically, all credit scores that are 660 and less, it's all better changes for those borrowers. For anyone who's got a basically 680 and above, it's basically worse. And anyone with 5% down to 20% down, it's worse. So
That's not good.
No.
That's not good. I mean, not good. Hey, we're at the halfway point, and we're after the break. We are going to dive deep with Adam Hartung and talk about what's going on in his world, from the financial markets, overall economy as well, how that impacts housing. 612-294-6949 is how you can join us anytime throughout the week or during the show. Again, mnrealestateshow.com. You click on the free market analysis. We can give you an idea of what your home is currently worth in this market. This is the Minnesota Real Estate Show. Yeah, it's again, a lot of folks watching, a lot of commentary. We had a comment said it's so absurd that we punish responsible spending behavior and reward those that have made bad decisions. You're spot on, Adam.
So,
Well, thank you.
so one of the, so on the purchase chart, so when you look at purchases, you look at rate and term refinances and cash out refinances, they all have different adjustments. So as I look at the purchase chart here, the biggest hit borrower is the borrower with a 720 to 739 credit score with 20% down. The old fee was a 0.5%. So again, on a $400,000 loan amount, that would be either a quarter in adjustment to your rate, or it'd be $2,000 in fee. It's now a 1.25 adjustment. So now it's going to cost them $6,000 on a $400,000 loan, or your rate's going to have to change by probably 0.75%.
I mean,
That is insane.
That is absolutely insane.
That's the biggest bucket that got hit by this.
And that is the cream of the crop. I mean, I realize there's even higher credit scores, but I mean, you're 20% down, mid 700
yeah.
credit score. I mean, that is who you should strive to be as a good citizen in the United States. I mean, that's what your goal should be.
Right.
And we're going to penalize those people.
It's kind of basic economic thought. It is very surprising that at the highest levels that these kind of decisions are made. I mean, that
Here's the funny thing too, is every credit score bucket, if you have less than 5% down, got better.
Again, we're going back to promoting less money down is better. I mean, what does that ultimately lead to? We've played this game before. We know. I mean, not only in theory, which anybody who's taken Economics 101 should understand what this is going to lead to, but it's not even just in theory. We've actually done it already. We had these policies. We know how this ends.
Yeah, that's right.
we know the story.
We got
ends.
short memories. Short memories.
It is unbelievable.
Yeah, it is very interesting. Interesting times, as always. Another comment says, so I should go ruin my credit before buying a house
Yes,
because it
that's
will be
great.
cheaper for me. Shaking my head.
So that's the feeling. Again, I will tell you, a higher credit score is still going to yield you a lower interest rate. So don't go ruining your credit, right? You heard it here on the show. Don't go ruining your credit.
Yeah,
it will
really.
get you a higher interest rate. Just know that basically they're trying to just even the playing field. They're trying to just sandwich the top with the bottom, and they're trying to get everyone together there. So still strive for a higher credit score. Still strive for down payment funds. It'll
Just
still
won't
be
get
better for
rewarded
you.
by it.
Right.
So comment as we kind of transition here. I don't want to, have a variety of topics, of course, but Adam, we talked yesterday. I thought it was interesting. You said with your models and everything you look at, you see interest rates dropping, long-term rates.
I do, yeah. And again, we don't never know for sure what's going to happen, and most of what we do in terms of how we manage investments is designed to be reactive rather than predictive. But yeah, I was just on the phone earlier this week with one of the bond manager portfolio specialists at one of the big mutual fund companies, who said, that they're predicting that long-term interest rates will probably drop in the neighborhood of 1% by the end of the year. So I don't know, Mike, if that falls in with kind of your expectations.
I can see that happening for sure. Absolutely. The trend will be downwards. Very confident in that. How far downwards? That's a little bit of a gamble there on guessing, but I could see it going down 1% from where we're at today. Yeah. That'd be we're 6.375, 6.5 today. Mid-5s
Mid-5s.
by the end of the year. Very doable.
Scott, before the break here, maybe we'll talk on air. I'm curious what you've seen, for example, the last 3 sellers that you've worked with. Actually, we're going back here live on Love 105 FM. We'll talk more about this. Thanks for tuning in. Welcome back to the Minnesota Real Estate Show, the second half of the show here. We're live every Sunday morning, 10 a.m. to 11 a.m. Mike Overson, Luminate Home Loans, Scott Wolmering, and myself, Ryan O'Neill. Hope your weekend is going well. We were talking in the first segment about the new Biden administration rule regarding interest rates. We dove deep on that. Scott, I'm curious, a lot of the talk is with people that have 2%, 2.5% interest rates, how or what will get them to move. And I'm curious for you, for example, if you think of your last 3 sellers that you've helped, what was their reason for moving?
Yeah, well, and we kind of talked about this as this year got kicked off, that the fun real estate transactions, the normal, hey, let's get a bigger house, or let's downsize, let's do whatever. Those kind of have gone away. When you're at 2.6%, you're probably not going anywhere. So the majority of the transactions are on the unfortunate side real estate. Either downsizing, a relocation, a divorce, those kinds of. So my last 3 sales, one was downsizing. So she was going from her big 2-story that we could, of course, can max out what she could possibly get for,
Okay.
and then she was buying.
So an older person
an
who is downsizing.
Correct. Yep. And so, of course, I contacted her and said, look, second best year ever to sell your house. And so you'll max out on your selling side, and then she's going to pay cash, which we just did, for a townhome. So she was downsizing. So she kind of got the best of both worlds, maxed out on the sell side. Other than that, buyers, relocation buyers. I've got one that was a newlywed couple. So, they're
No other specifically sellers though.
Oh, sellers.
So your other 2 sellers.
Downsizing as well. One was going from a townhome, a large townhome, to a smaller condo, and the other was a relocation. They're relocating to Florida.
So they're moving out of state.
Moving out of state.
So I'm curious again, and it maybe agents watching, listening, what you're seeing as well in the market, your most recent seller clients. Yeah, I mean, I think again, the lower rates, guys, this is going to help though for those people that again are at 3% during COVID that want to move, that need to move. They're having kids, they're expanding their families. I think we will see more inventory. It's just hard right now.
Yeah, I saw an article the other day where they're like, they're talking about where the interest rate needs to get in order to get those people off the fence to move.
Yeah.
And they were saying it looks like 5.5% is that mark. We get rates to 5.5%. That's going to now spur a lot of activity as far as people selling and buying something different. I can see that. I think I was saying too, if we can get to the mid 5s by the end of the year, I think we'll be sitting good, and I think we'll see a lot more activity come up.
Well, and I think if we get to the mid 5s, and then we start to see some ARM products that have a little teeth in them.
Right.
I mean, we haven't seen ARM products that have been worth a crap for a long time. I mean, back in the day, rates were at 7.5%, but your 5/1 ARM was at like 5.25.
Sure.
Well, that was a good option. It was a 2% difference. Now they're so minuscule. But I think that if that came back, rates got back into the 5s, and then there was a decent 7/1 ARM product out there that you could get in the 4s.
Yeah.
I think that would help.
Hey, sorry.
No, that's fine. I was going to say the inflation causes that inverted yield curve where ARM rates get pushed up and fixed rates don't get pushed up as much, and it gets sandwiched in the middle. So that's where we're at now on those.
Want to transition to our friend, Mr. Adam Hartung, Midwest Money Management. Wonderful guy, outstanding firm here locally in the Twin Cities. I have many family, friends, people that I've personally referred to Adam. He actually is the gentleman that got me started in investment property back in 2001. There was nothing in it for Adam, but Adam helped me become a real estate investor. I bought a duplex in 2001. And since that time have continued on. But Adam, again, a lot going on. Obviously, as we're talking about what's new in your world specifically.
It's not new as in just in the last couple of weeks, but really just taking a step back and looking at this rise in interest rates, this dramatic increase in interest rates over the last 6 to 12 months. And, I spend a lot of time, and we talk on this show about the negatives that brings. And I don't think there's any place where it's more pronounced than in the housing market, how this dramatic rise in mortgage rates has really hurt the housing market, of course, because it makes everything more expensive. But I thought it was worth pointing out that just like higher interest rates have some negative consequences, there are some positive things and opportunities that have been created in the last 6 months due to higher interest rates as well. And we shouldn't ignore those, like the fact that savings accounts, high yield savings and money market rates now should be somewhere in the 3.5% to 4.5% range. So, if you're a listener out there and you've still got a bank account that's paying you, nothing or 0.5%, know that you can very easily, if you spend a time looking, and I'm talking about FDIC insured here, you can get 3.5% to 4.5%. And I would say if you're getting anything less than 3.5% on savings right now, now, you should be looking for a better opportunity because you can. And what's crazy is interest rates have been so low for so long. Think about this. We have an entire generation of young adults that don't realize that this is not a normal situation, in normal times when you have money saved in the bank, you actually get paid interest by the bank for letting them use your money. How long has it been since any of us really thought about it that way? And I'll tell you, it's going to be better for all the markets, not just for savers, but it's going to be ultimately healthier for stocks. It's going to be healthier for bonds because we have a more normal environment. I mean, when interest rates were artificially zero, and let's be honest, this was not market forces that took interest rates to zero. It was Fed policy that artificially kept interest rates at zero, but it distorts everything. Money, there is no benefit now to saving. It's kind of like punishing people for having a higher credit score, by the way. We were punishing savers by telling them, hey, if you're doing the right thing and trying to save money, we're not going to let you get ahead. We're going to force you to do something riskier than maybe you want to, like put money in stocks. There was no benefit to putting money in bonds. I mean, again, it's all these distortions in the marketplace. So
You were saying that a long time. Do you remember over the years from
Mhm.
doing the show? Adam was always on. That was kind of your script, if you will. I mean, you talked a lot about it.
and again, all of this was predictable. I mean, this day, the fact that we were going to have to get to this point where eventually things were going to have to change, and the pain that it was going to cause when it ultimately happened. Hyman Minsky's a famous economist who, and I'm paraphrasing, this isn't exactly what he said, but it was something to the effect that the more governments try to stabilize economies artificially, the more ultimately unstable they will become. And this is what we're seeing. This is the consequences. But again, take a step back, look for the opportunities. So the opportunities are, number one, as a saver, you should be getting 3.5% minimum on your savings right now. Number two, bonds are more attractive certainly than they were 12 months ago. I'm not saying that there isn't any risk in bonds right now, but they're certainly a more attractive investment. And even for something like our tactical stock model, which is our primary investment model, which, as long-term listeners know, can be invested anywhere from 100% in stock investments, stock mutual funds or ETFs, or 100% in cash. Well, because the model is designed to move and hold cash at times of risk, for the last 10 years, we've been getting no more than 0.15% on cash that we hold. Today, in that exact same model, we're getting 4.5% to hold cash. I mean, my best estimate is that over the last 10 years, if we had been getting 4.5% on cash, it probably would have increased investment returns by 1.5% to 2% a year. I mean, it's a big deal.
So there's opportunities.
There is opportunity, and like everything else, you got to recognize the negatives, but also look for where are the benefits, where are the opportunities.
One thing I would say too, as people watching, listening to Adam Hartung, again, I think the hesitation to ever reaching out to someone like an Adam is, again, hey, you know what? I'm just starting out. I just got out of college. I don't have any money. Or, you know what? I just went through a difficult time. I just, filed a foreclosure or whatever it is. And I think it's like having a trusted person on your team who can help advise you and be aware of things that you may not be aware of, Adam. And that's what you're doing. And your model is based on you get paid if people do better. In other words, if they do better, you make money. If they're doing worse, you're not doing well. So I mean, it's a good model.
No, I appreciate that, Ryan. And that is, we do everything we can you can never eliminate conflicts of interest. I mean, if you're going to pay me, there's always going to be some conflict of interest, but we certainly try to arrange things in a way where we minimize conflicts of interest, where our interests, lie with our clients. And then very much everyone on our team has the mentality of that, if you kind of give freely to people, it all comes back to you in the end. And so, we have no problem, and we do this all the time where there's a young person that we want to sit down with, and we'll spend, an hour and a half, 2 hours with them. And sometimes it makes sense and they become a client like immediately following that. There's something we can help them with. And sometimes there's not. Sometimes it's just, hey, we just point them in the right direction, get them started on the right path. And maybe they become a client 2 years down the road or 5 years down the road.
Student loan debt,
These are
all the different things that
we can help people at least make sure that they're on the right track. Because again, there are things that in our industry we kind of take for granted that seem so basic and so obvious. And yet, again, nobody teaches you all this stuff when you grow up in school unless your parents are. And so, and there's a lot of people that can use help just kind of getting on the right path. And our team's happy to do that. We got 4 advisors on our advisory team. 2 of them are 25. So again, we have a young advisory team, which also makes those people feel more comfortable to come in and talk to us too, because they can talk to a peer of theirs if they're, in their mid-20s.
Yeah, we're at our final break here, and we'll come back, finish the discussion with Adam Hartung, Midwest Money Management. This is the Minnesota Real Estate Show every Sunday morning, 10 a.m. to 11 a.m. We're local here at Love 105 FM. Throughout the week, if you are a buyer, a seller, a real estate investor, you have questions, please don't hesitate to reach out to us. We've got a top agent on the Minnesota real estate team here to help you within a few hours of the Twin Cities, Western Wisconsin, as the #1 selling RE/MAX team in Minnesota. This is the Minnesota Real Estate Show. So good points, Adam. Another comment. Someone said most financial advisors won't work with someone unless they have $500K to invest.
Well, that's a true statement, and I don't know what percentage, but you are right. I mean, most firms have account minimums, and we have certainly thought about doing that in the past, but every time I just go back to it's not who we are. It's not who I want to be.
Yeah.
And the reality is we do make more money off our larger clients than our smaller clients. But I don't think, I don't think any of our smaller clients feel like they're small clients when they work with us.
Well, your bigger clients should actually give your smaller clients some of
That's
their money.
Yes.
No, that's a good idea. I think Biden had that idea.
Yeah.
Right? Yeah.
Yeah.
Have your more affluent clients just give your lower ones some money.
Yeah, because then they
I'll
get,
bring that up
Yeah,
at our next
yeah,
advisory
yeah.
council. See what
because
they
then
think.
now you get more people.
Well, I mean, no,
above
it
the
works. The
minimum.
government's doing it.
Yeah.
If the government's doing it, we know it works.
I mean, how do you really feel?
I mean, my gosh, it's been this way forever. Just get your hands off of it. It's like, I don't know if you remember, but this always stuck with me. When Ronald Reagan said we could give everybody on welfare $35,000 a year. And we would be way cheaper than running our welfare system.
Mm.
I mean, it's like, that's what the government does. It's like, just get out of it.
Mm.
Get your hands out.
Interesting, Mike.
Well, when people start asking me, where interest rates today, I'm gonna start asking, well, which Biden bucket are you in?
That's right.
I'm gonna name it the Biden bucket.
And I do think it is incumbent upon all of us to explain these things. Scott, you said that the buyers are never going to know that they pay more on their mortgage rate, but mortgage brokers should tell them every single time. You should show them exactly how much extra they're paying, because these policies are never going to get fixed. They're never going to get better unless people understand. I mean, one of the smartest things the government ever did when it comes to income tax is mandating payroll taxes be withheld from your pay, because if they made you write a check the way self-employed people do, if
Never get it.
everybody had to write a check, people just wouldn't comply, and the whole system would collapse.
Right.
Because there would be outrage over what people pay
Absolutely.
and then what people don't pay.
Yeah, again, 612-294-6949 throughout the week by phone or text is how you can reach us. Here talking about listings. We had another comment come in just asking where listings were coming from. Bryce Schenke, great agent on the Minnesota real estate team. He said, I have a seller who's only moving due to job relocation. They bought in May of 2021 for $370. House is probably worth about $350 now. That's a tough pill to swallow for some sellers, especially that quick of a move when you're buying and reselling very quickly like
When
that.
did they buy?
2021.
21.
Yeah, because we had a reset of about 10%. I think a year ago we were, 384, and now I think we're 340 ish for average sale price. So it's been about a 10% drop.
I mean, back then though, in order to get a house, what did you have to do in 2021?
Well, you were buying a rate. You weren't buying the value of the house.
Right.
And and anyone at that point had to know that a little bit. I mean, if you're writing $100,000 over, the house probably is not quite worth that. You're buying a 2.6% rate.
So again, though, did the values actually drop, or were buyers just wanting to pay more?
They were,
you know what I mean?
I believe they were.
Because what's interesting in the market, if you look at the Twin Cities, the median sales price has been very consistent. In 2022, February, it was 340. February of 2023, it's 342. So slight uptick, but like Bryce commented, if it's a quick buy and sell, hard to make money.
Also drives home the point that the list price is really just a suggested number to start
Just
at,
a teaser.
right?
Here we go. We're going back live on Love 105. Thanks for tuning in, everybody. Hey, welcome back to the final segment of the Minnesota Real Estate Show. Sunday mornings, we're here for your questions, comments, thoughts, 612-294-6949. Throughout the show, we've been discussing the new Biden administration rule regarding mortgage rates, how that's going to impact people moving forward. And we've been discussing with a preferred partner, Adam Hartung of Midwest Money Management. Adam, any other tips for folks or things that people should be aware of here? Tax season just got done right now. Anything else for people to be aware of?
Tax season got done, and it is a good idea if you're working with a financial advisor. I would get in the habit of asking them to review your tax return with you every year. That's something that's a service that we offer for clients. We don't do tax prep work, but we will review tax returns, just looking for are there any obvious mistakes? Are there opportunities, things you could have done better or could have been more efficient on? In fact, we've got a software program that we use now that we can run a return into, and it's got AI built into it that will actually look through the return and just bring up things, either things to question or opportunities maybe on the return. So it really is a good idea to be looking at those things more closely.
That's a cool service.
That's a very cool service.
You think about just the human element for accountants, CPAs, probably.
And again, it doesn't matter whether you do your taxes yourself or you use a CPA. The reality is things get missed. And I mean, I feel bad for accountants. I mean, you want to talk about a group of people who can't possibly know everything that they're expected to know. I mean, the tax code is over 80,000 pages long. I mean, there is not a single person on the face of this planet that knows everything in the tax code. So, I mean, it is, again, it's a challenge for tax preparers to not miss things or make mistakes as well.
Before we forget, Adam, best way for people to connect with you at Midwest Money Management.
They can find us online at mnrealestateshow.com or midwestmoneymanagement.com. They can also call our office directly at 651-204-3000. Again, that's 651-204-3000. And you can call the office. You just have a question, want to talk to somebody on the phone, you can. Or if you want to set up what we call a compatibility consultation, there's no cost to that. It's just where we sit down for 45 minutes to an hour and 15 minutes, somewhere in that range, and just talk about your situation, whether or not there's anything we can do to help you, and whether that's just giving you advice and sending you on your way, or whether it's actually developing a relationship beyond that.
Great job as always, my friend.
Thank you.
I feel bad for accountants too.
You do?
I do. Have you ever been to an accountant party? They're not real fun.
You're terrible.
They're not. I'm not trying to offend. I've got a lot of family members that are accountants.
You're terrible.
But they typically stand in the corner a little bit quiet. It's a little quiet group.
That's terrible, Scott. Mike, isn't he bad?
He's so bad. He speaks the truth.
Yes.
But Scott's not going to sugarcoat it. And if you've listened to the show before, you know that already. If this is your first time listening, now you know. Scott's not going to sugarcoat anything. He calls it how it is.
Hey, Mike, again, as we head to the home stretch here, interest rates, buyers in this market. So the real estate market we've talked about is down 30% in closings, ballparkish. What is the mortgage community seeing for year-over-year business numbers?
I mean, it's the same.
Yeah.
Our real estate mortgage numbers just mirror each other so closely. It doesn't matter what type of market you're in. They mirror each other very, very closely. So we're seeing the same thing, down 30, 35% for the year, which was expected. We all knew this was kind of coming, but we were also up how much, during the COVID years. This is really just balancing those years out. It's going to bring us back to normal. And we spoke about that before. So
my question, we talked a little bit earlier, some of it was off air, about, the potential for interest rates to go down by the end of the year. So let's say mortgage rates came down by 1% and got into that 5.5 range you were talking about. Especially with all the new rules and the new add-ons and things, how many of the people that maybe purchased a home at a higher interest rate in the last 6 months would potentially benefit from a refinance at 1% lower? Do you think that's enough, or do you think it needs to be even lower yet before they would benefit?
We'll definitely see some refinances coming through, at 5.5. If we get a 5.5, there's a lot of people that we locked at 6.75, 7.25. There's a lot of people locked at those rates. So, if you're at 7.25 and it's 5.5, that's definitely going to spark some people to be like, yeah, that's enough for me. That's
No,
a pretty good savings.
for
So
sure.
Yeah, part of it too. A lot of people have asked me over the past couple months, what's driving so much of the demand from a buyer standpoint? And I think a lot of the rents across the Twin Cities are expensive. Rents went up a lot during COVID. If you're renting right now, you've gotten rental increases. Things are expensive from that standpoint. So, Mike, from an affordability standpoint, and Scott, people are looking at other options. And a lot of younger folks too, maybe have been living with mom and dad, saving some money. Now they're like, hey, let's go buy that first home. So that's where that 450 and under price point in the Twin Cities, there's so much buyer demand, people looking to move from renting to owning.
Yeah, for sure. It is when you were just talking about affordability, we talked about it a couple weeks ago on the show that for whatever reason, I just looked at what the household income was in 1999 and what your household income is now. And it's a difference of $6,000 from 1999. It was 52 or 58,000 and now it's 62. And so the point of that is everything is truckloads higher, cars, groceries, gas. And for a young couple coming out, they are living with their parents. You can't afford to get your first job out of college now and live on your own. And that's a shame.
Yeah, it's hard. It is hard, Mike.
You got people spending $3,000 on rent, but they've got a roommate, so they're splitting it, just so they can get somewhere where it's at least a little bit affordable.
Yeah, we do those investment property seminars every month. This past week, we did our investment property 101 seminar. If you're want to learn how to be an investor in this market to buy investment property, whether it's you're fixing a property up and holding it as a rental, whether you are looking to do a Airbnb, a VRBO, Mike, those seminars are always a good spot to start.
very good spot to start. Free information, no pressure. No credit card machines in the back room trying to sell you something. It's just real estate professionals and mortgage professionals answering your questions and giving you real info.
Yeah, good stuff, guys. Hey, last thoughts, Adam, for folks as we head to the home stretch.
This is just interesting. I just remembered I got this text a couple days ago from a friend whose grandmother had gotten one of those cards about, what things cost the year they were born. So this is from 1943. Price of a new home in 1943, $3,600 in the United States, and the average annual income was $2,040.
Yeah. Yeah, and so you would look at that and go, "Oh my God, how can you live on 2,040 really, really well?"
Yeah,
you can live really, really well on $2,040 a year.
Because that's basically a house was basically 150% of income, or think about that. If the median income right now is 60,000 or whatever it is, I mean that means the average house would only be
90
less than
Yeah, it is housing. What is the solution? What is the solution to get more affordability, Mike?
I mean, that's a great
It's clearly
question.
to penalize the people at the top.
Yes, firm believer in that.
There's-
We need to penalize the top, give everybody else a break. That will make us that'll bring us together.
Yeah,
We're all
it
singing
is.
Kumbaya at
Yes,
the end of the day.
exactly.
Yeah.
It has been a fun show here at the Minnesota Real Estate Show. Again, applywithmike.com is how you can connect with Mike Overson and your team. Mike, any other last thought for our listeners?
So we talked about, interest rates coming down and things like that we were expecting that at the end of the year. It still does not make sense to wait to buy a house, right? So if you wait to the end of the year to buy a house, that house is probably going to cost you 5% more than it does today. So if you're going to gain 15,000 in appreciation in a home, and let's say you buy today and you're going to refinance at the end of the year, it's going to cost you, let's say, $4,000 to refinance. Would you rather pay $4,000 to put $15,000 in your pocket, or would you rather not buy a house and put nothing in your pocket? So there's still a cost to wait. It's still a good time to buy. So definitely plug in with us. We'd love to help you with that.
Yeah, Scott, last thoughts?
No, just along those lines. I mean, I've predicted it all year. I think it's going to stand true that we are going to have an exceptionally busy, end of spring, early to late summer. And I think that Rates dropping into the fives, maybe in May is gonna spur that along. But I think we're gonna have a busy fall.
Great job today, guys. Adam, nice work, buddy.
Thank you.
Hey, this has been the Minnesota Real Estate Show throughout the week, 612-294-6949. We're going to be back next week again, taking your questions, comments, thoughts online and by phone, mnrealestateshow.com. Enjoy the rest of this weekend. Take care. Thanks for joining us on social media. It was a fun show, a lot to talk about. Guys, we'll be back next week.
We will.
Absolutely.
No, I won't.
You won't.
No, I'm going to Arizona.
All right. Scott won't be here, but we will be here. Thanks again, everybody. I enjoy the rest of the weekend. Take care.